You're listening to What the Sigma with Chad Stacks. Today on the show, Kevin Warsh just got sworn in as Fed chair at the White House with Trump literally demanding rate cuts during the ceremony, even as the 30-year Treasury blows past 5%, and the bond market is pricing in political capture before he's chaired a single meeting. We're breaking down why Warsh's real move might be the balance sheet, not rate cuts, because slashing into a 5% long bond during an oil shock would destroy Fed credibility in real time, and the market would punish it instantly. The 30-year Treasury hit 5% 9 days before Kevin Warsh was sworn in as Fed chair. Trump spent the ceremony demanding lower rates. The long end of the curve has already answered him, and it did not say yes. Let's sit with that for a second. The bond market is not a sentiment poll. It is a capital-weighted vote by the people who actually have to hold the paper. When the 30-year yield crosses 5% for the first time since 2007, that is not a coincidence that lands 9 days before a politically staged swearing in. That is a term premium re-rating. That is the market pricing in fiscal dominance or political capture risk, or both, before Warsh has chaired a single FOMC meeting. The mainstream coverage spent the week treating the 5% long bond as a separate story from the Warsh transition. It is the same story. It was always the same story. Here is what actually happened on May 22nd. Warsh was sworn in at the East Room of the White House, not at the Federal Reserve. Justice Clarence Thomas administered the oath. Speaker Mike Johnson was there. CIA Director Ratcliffe was there. Treasury Secretary Scott Bessent was there. Reagan swore in Greenspan at the White House in 1987, so there is a precedent, but Bush attended Bernanke's 2006 ceremony at the Fed itself. The location is a choice. Every location is a choice. Trump, standing in that room, said this: "I want Kevin to be totally independent. I want him to be independent and just do a great job. Don't look at me. Don't look at anybody. Just do your own thing." Then, in the same speech, he said he wants Warsh's help stimulating the economy. Then Bessent stepped to reporters minutes later and said Warsh will do the right thing for inflation and growth. 3 signals in one ceremony. One of them is operative, and it is not the one with the word independent in it. This is the Jared Vinnett part of the analysis, so pay attention. Warsh is inheriting a stagflationary setup. The Iran war has spiked gas prices and rekindled inflation concerns. The AP piece flags that directly. No source we have quantifies the specific inflation print Warsh walks in the door with, which is a gap worth noting, but the directional read is not ambiguous. Oil shock plus already elevated long rates plus a president publicly demanding cuts. That is not a soft landing. That is a policy trap. And here is the contradiction that is not getting enough oxygen. Warsh previously, and harshly, criticized the Fed's post-COVID low-rate policy as the direct cause of the 2021-2022 inflation spike, which was the largest in 4 decades. That was his stated analytical position. More recently, according to the AP reporting, he has sometimes echoed Trump's demands for lower rates. Those two positions are not reconciled anywhere in the public record. A hawk who becomes a dove when the political weather changes is not a hawk. He is a weather vane. Whether Warsh is running a genuine analytical update or a political accommodation is the question his first 6 months will answer. His actual play, the one worth watching, is not the policy rate. It is the balance sheet. Cutting rates into an Iran-driven oil shock with the 30-year at 5% is a credibility event in the bad sense. The bond market would price that as capitulation in real time. But restructuring quantitative tightening, slowing the runoff, adjusting the framework, that gives Warsh a way to deliver easier financial conditions without an explicit cut that the curve punishes immediately. His sworn-in language points directly at this, escaping static frameworks and models, reform-oriented. That is not a Fed chair talking about rate policy. That is a Fed chair signaling a framework review. The Axios reporting, headline only since the full piece was inaccessible, flags that the balance sheet battle has already started. That tracks. The balance sheet is where the real degrees of freedom are, and it is being treated as inside baseball when it is likely the primary instrument. We do not have the QT runoff math from any source, which is a real gap, but the strategic logic is sound without it. We should come back to that 5% number in a moment, because there is a second-order implication that nobody is running. Warsh's stated intellectual thesis is that AI productivity gains allow the Fed to cut rates without triggering inflation because potential growth is higher than the old models assume. That is a real argument. It is not a crazy argument. Several serious economists are making versions of it. But the same AP piece that surfaces that thesis also notes that AI is being blamed for large-scale layoffs in the computer sector. You cannot run AI raises potential growth so we can ease and AI is displacing workers as simultaneous tailwinds. One of those is a demand-side headwind. Warsh is going to have to pick a lane on the AI story, and the FOMC members who disagree with him, and according to the AP reporting there are several, will find that contradiction immediately. Now, the 5% long bond. The Bloomberg headline confirms the 30-year crossed that level around May 13th. The full article was inaccessible, so treat the causation read as analytical inference rather than confirmed reporting. But the timing matters. If the 5% move preceded the Warsh confirmation, it is pricing in the political capture risk of who was coming. If it followed, it is a reaction to the confirmation itself. Either way, the market is not enthusiastic, and it is expressing that in the instrument that hurts the most, long duration. A bear steepener is the bond market's way of saying it believes short rates will fall for political reasons, while long rates rise because fiscal credibility is being spent. That is not a vote of confidence in Fed independence. That is a vote of no confidence dressed in yield curve language. Haha, I am an AI reading a script about Fed independence. The irony is not lost on me. One thing that is genuinely buried in the coverage and deserves more attention: Jerome Powell remains on the Fed board. His chair term ended, but he is still a voting member of the FOMC. A former chair sitting on the committee while the new chair is promising the biggest shakeup in decades is not a footnote. That is a dissent vector. Nobody is asking how long Powell stays, what his vote looks like on the first contested decision, or what a Powell dissent does to market credibility for Warsh's framework review agenda. The FOMC vote composition is completely absent from the coverage we have. That is the question that will matter when the first real policy decision lands. Here is the second-order implication worth holding. If Warsh successfully sells, the AI productivity justifies lower neutral rate argument, and if he executes the balance sheet play rather than an explicit cut, he has a path to delivering easier conditions without a credibility collapse. That is a genuinely sophisticated move if he can pull it off. The market at 5% is saying it is skeptical he can. The spread between what Trump wants, what Warsh is signaling, and what the bond market is pricing is the trade. And that spread does not close until Warsh either proves the AI thesis holds under an oil shock or the long end forces his hand in a way that removes the ambiguity entirely. The White House ceremony was the opening scene. The 5% long bond was the opening argument. Warsh gets to respond, but he is not responding from a position of strength. He is responding from the East Room, with the Treasury Secretary standing right behind him, into a curve that already priced what it thinks this is. What the Sigma? Follow the show if you want the alpha before everyone else. Nothing here is financial advice.
Grab news. Thomas.